Hey everybody, this is Seth Baer with Investor Loan Source, and I've invited Tom Berry, co-founder and CEO of Investor Loan Source, to come and talk to us about the changes in the market and our current state of the market. As some of you guys know, he gave this talk in January, but we've seen some major changes in the market. He's going to go over a little bit of what we've seen here, so let's get into it.
So yes, 6 weeks ago, we did the market forecast at the Wealth Club. And at that time, everything was just kind of on an even keel. Over the last couple of weeks, though, we've seen some major changes, have we not?
Yes.
So let's talk about the stock market first. If you're a stock market investor, you've probably been on this wild roller coaster, particularly over the last week or so, with record gains, record losses, or near record anyway. So what is happening there? What's causing that, right? Well, fear. Fear and uncertainty are what's causing it. And I don't think that these market changes are based on fact. They're just based in emotion. Does that make sense?
Yes.
So as real estate investors, we don't make investment decisions based on emotion. We make our decisions based on facts. So the coronavirus scare and things like that, I just don't think are going to have that big of a long-term impact on the real estate market. Now, the other thing that has happened this week is oil prices took this big plummet, right?
Yes.
And we've got oil prices in the $32, $36 a barrel range. Will that affect real estate prices in Houston? Absolutely. Over a long period, if prices stayed at that level, we would definitely see dramatic layoffs, and we would see more bankruptcies and things like that in the oil fields. And will that affect Houston real estate? Absolutely, it would. Now, we don't know if that's going to happen. We don't know if it's going to stay down, if it's going to go back up. We don't know, right? So what do we do with all of this information as real estate investors? I think the first thing that you need to do is invest based on fact. Use the formulas that you have used your entire real estate career and don't deviate from them. Now is not the time to get cute. Now is not the time to get cocky and think that you've got it all figured out and go do things that you haven't done before. I think stick with the basics, stick with what work, and I would say stick in the bread and butter price ranges of real estate. Stay in that under 250, under 300,000 range, and you'll be fine. Another bit of advice is wholesale. That is an opportunity to take risk-free profit out of a real estate deal. I kind of like that idea, particularly in a volatile market. So those would be my ideas for what to do with this information until we have a better read on how long this is going to last.
Okay. So what would you say to a new investor who's just coming into this market where it can be kind of scary for them?
Well, sure. And a new investor might look at this market and say, oh, my goodness, I don't want to get involved because I don't know what's going on. And I would say there is never a bad time to get into real estate investing, but there are bad times to do certain strategies, right?
Yes.
Would this be a bad time to go flip multi-million-dollar houses if you've not done that before? Yes, it'll be a bad time to do that. Would it be a bad time to buy office buildings in the energy corridor? Probably, right? So stick with the basics. Again, even to a new investor, this could be an opportune time. As you see other people getting scared and running the other direction, you may find opportunities. So I would say definitely it's a good time to get involved.
Absolutely. So what are some of the leading indicators that we should be looking for these upcoming changes as they're happening?
So a couple of leading indicators, and these are simple things anybody can look up, right? Mm-hmm. On the wholesale side, if you took real estate and divided it by wholesale side, retail side, I would start with the wholesale side and say some of the leading indicators to a softening there, which, by the way, I think we need so that we can get some decent deals in the current cycle, would be seeing a lot more email blasts of wholesale offerings, right? Over the last couple of years, we really haven't seen that many because they're getting sold before they ever get to an email blast stage, right? Another indicator would be if you're seeing that same deal emailed over and over with price reduced, price reduced, price reduced. That would indicate a little bit of a softening in the wholesale side of the market, which, by the way, would be welcome.
Yes.
And then on the retail side of it, I would focus on days on market. Just constantly watch days on market, not necessarily in the whole city, but days on market in the neighborhoods and in the subdivisions that you're working. And as you start seeing the days on market creep up, you're also going to start seeing inventories creep up. We're not seeing that yet. Days on market are extremely low. Inventories are really, really low in the 3-month range, 3.5-month range. So we're not seeing any kind of a crash on either side of this thing at this point.
Okay. Well, that kind of concludes all of this. So thanks for listening, and we'll see you on the next video.